Hi, hello. Welcome to see you again. Alright, thank you very much for coming back to watch another video. Did you come at this video because of last week's video that you watched? Is it because you are just curious, Nick, how can someone actually invest in every direction where the market moves? Right, if you have not watched this video, you might be curious why am I talking. You might actually watch one of the video on the link up here. I did mention in the previous video actually how do you invest in the stock market and generally in three directions. Alright, and I did mention in that video, alright, it's talking about something about options. Alright, if you want to know more, this is the video that you want to find out what actually is option investing. Alright, let's get started. Alright, so before we carry on, the usual stuff. Alright, so if you're brand new to this channel and you haven't subscribed to it but you like this video or the series of videos that we have done so far, alright, please click on the subscribe button so that you will be part of this community. Alright, but also not to forget to click on the notification bell button beside it so you will be notified every single time when we actually upload a new video in this channel. Alright, a quick disclaimer, anything that we mention in this channel that actually particularly talking about any stocks and shares, they are just purely for educational purposes. Right, please do your own due diligence before you do any trading and investment. Alright, okay, so in this week video, we're going to talk to you and share with you what is option investing, which I briefly mentioned it about in the previous video. Alright, so what actually is option investing? So we need to find out what actually is an option. Okay, an option is basically just a type of financial instrument. There are many different ways you can invest. There are many different types of instruments. Option is just one of them. Alright, so basically what is actually an option? Option is just a contract, and just like any other contract, it has terms and conditions attached to it. Alright, so for option contract, it typically have stated what type of contract it is. Usually in the option market, there's only the put contract or the call contract. Right, and every contract actually represents 100 shares. Okay, and in the contract itself, it usually will state what is the agreed price that we will do certain action based on that price references. Or another way, in the market, or rather in the option world, we actually call it the strike price. Okay, and just like any other contract, option contract also has an expiry date, and this contract itself will have a value. Alright, in this option world, we actually call it the premium. Right, so actually, why does people actually want to invest using option instead of standard just buying and selling of stocks and shares? Right, many people actually use options as a leverage tool. Right, they want to find ways how they actually can leverage on this tool to make more or protect themselves from the market. Right, so mainly the key ideas of actually using option actually to take advantage of the option mechanism. One of the way you actually use it to hedge your portfolio, right? Or some other people actually use it as a way to collect passive income every month, every quarter, or every year, right? And certain strategy allow you to actually lower your capital in terms of investing so that you put a smaller amount of money trying to mimic a certain potential gain. Alright, and last but not least, options actually allows you to invest in all three directions of the market, whether it goes up, whether it goes down, or it goes sideways. There's always different option strategy allows you to actually profit on it. Okay, so what type of options are there? Basically, like I mentioned earlier, option basically there's two types. One is the call option, which is actually by definition means the right to buy at an agreed price, and the other type is actually a put option, the right to sell at an agreed price. Alright, so this is the definition of options. Is something that you need to remember by heart. So once again, the call option is the right to buy, the put option is the right to sell. Alright, okay, so let's just go through and break it down one by one. So what is actually call option and how it works? Right, so remember call option actually is right to buy. I just leave it at the top so that there's always a reference for you in this video. Alright, so just for example, let's say you take a company ABC. Currently the share price is at $10. Okay, so you now own this call contract, right, at a strike price of $10. Okay, basically it means that, right, you have the right to buy the share at a strike price of $10 if the price go up or go down. Alright, but let's say a typical scenario, where let's say at a point of expiry, let's say 3 months down the road, okay, the share price actually went up to $30. How much do you think is the worth of this contract at the end of expiry? I just give you a couple of seconds, think about it. What do you think is the value of this contract? Alright, actually it's $20. Do you get it? Right, if not, you might be thinking, how is the premium is $20? Okay, right, very simple, just let me run through with you. Right, remember the call option is the right to buy. Alright, so when the share price went up to $30, will you want to buy from the market $30, or you want to actually exercise the call contract so that you can actually buy at $10? Right, in most cases, you will want to actually exercise this contract to buy at $10. Am I right? So if you exercise the contract to buy at $10, alright, you will actually own the share at $10. Okay? Then after that, since the market is selling at $30, you can immediately sell your shares up into the market at $30. Right? At the end of the day, we will actually profit $20. So am I right to say, so at the end of the 3 months when the option near expiry, am I right to say that piece of contract easily will actually worth $20 if you were to sell to anyone else? Because by just the person actually take that contract out into market, he or she can quickly, immediately, and going to gain $20 out of it. Right? So that's how you actually derive the value of the contract. Right? So let's run through another example so that actually drill this down clearer for you. So likewise, just let's say a company XYZ, currently share price at $50. You have a call contract, alright, at a strike price of 50. 6 months down the road to expiry, let's say your share price went up to $60. How much do you think is the value of this contract after 6 months? Think about it. What do you think it is? Remember, as a call contract, you have the right to buy. Alright, so the premium of this contract is going to be $10. Do you get it? Alright, let's run through together and see how do we derive with $10. And remember, what's the premium? How actually we derive the premium of this $10? Firstly, when you have the contract, you have the right to buy at $50. Alright, because you have a contract. Also, if you're going to buy when the market actually went up to $60, will you want to buy from the market at 60, or you prefer to exercise the contract to buy at 50? Right, most people, most cases, you will probably like to do the same thing. You're just going to buy at $50 at a lower value. Right, so if you exercise the contract buy at a lower value, after that you actually own the shares. If you sell back in the market, which actually costs $60, immediately you will be able to make $10 profit. Right, so this contract will easily worth at least $10 at the end of the expiry. Clear so far? Alright, so now we have an idea about call options when the price went up. Let's look at a few other scenarios. What's going to happen to the contract, okay, in different kind of situation. Alright, so just let me run through with you very quickly. So imagine same thing, a company ABC, but this time around the share price at $20. Alright, just going to work this out. Okay, if the share price is $20 after 3 month expiry, in few different scenarios. Scenario 1, the share price went up $40. Alright, what do you think the premium of that call contract is going to worth at the end of 3 months? Alright, that's scenario 1. Scenario 2, alright, same thing, you have a call contract at the strike price of $20. 3 months later, assuming the share price doesn't change, it stays flat at $20. What do you think is the value of that contract? Okay, and in the third scenario, same thing, you have a call contract, strike price $20. 3 months down the road, instead of going up, the share price went down to $5. What do you think is the value of the contract? Right? I just give you a couple of minutes. You might want to pause this video, go and work it out, think it through. What do you think is the value of each individual contract after end of 3 months at different scenario when the share price went up, share price stayed flat, and share price went down? Alright, so welcome back. So do you actually get this? Right, the first scenario is the share price have went up $40. Right, the premium is going to be $20. Do you get it? Right, because you have the right to buy at $20. When the market went up to $40, will you want to buy from the market at $20, or will you want to actually buy at the market at $40, or you want to exercise the contract to buy at $20? You will definitely want to exercise the buy at $20. When the market now is $40, after that you can actually sell to the market immediately and profit at $20. So the contract easily worth $20 at that point of time. Okay, for the scenario 2, if the share price is $20, the market stays flat and it actually expires, it stays at $20, what's going to happen? Will you want to buy from the market, or you want to exercise? Technically, they are still the same. Why not just buy from the market? There's no difference. So this paper doesn't give you an extra advantage. So this contract will just easily actually expire, worthless. So the premium is 0. It's just worthless. It doesn't worth anything. Okay. How about the third scenario? You have the right to buy at $20. The market now has dropped to become $5. If you were to buy, will you want to buy from the market at $5, or will you want to exercise your contract to buy at $20? Well, naturally everybody want to buy at $5. Who want to buy at $20, right? Right, so if you're not going to buy at $20, am I right to say you're going to leave this contract expire worthless? Exactly, that's what it's going to be. So the premium will going to be worthless. There's no value to it. Right, so now you get an understanding about this, how call options work. So generally, if the price goes up for a call contract, you will make money. If it stays flat or go below, your call contract will actually start to lose money, or rather it will just expire worthless. Right, so now we are done with call contract, call options. How about put option? Alright, put option basically is the exact opposite of what call option is. Right, so remember, let's run through what's the definition of put contract. A put contract is the right to sell. Right, the right to sell. Okay, so let's use something very simple, very similar is illustration. The company ABC now share price $50. So you have a contract, you have the strike price at 50, you have the right to sell any share if the share price goes below 50. Alright, so now the share price has dropped to $20 after 3 months when it expires. What is the value of this contract after 3 months? Right, think about it. Alright, just now we work with call, now we work with put, the right to sell. Right, so what do you think is the value of the paper? Right, the premium actually is $30. Do you get it? Alright, so how to actually derive 30 value? The premium become 30 for put contract. Alright, just break it down. It's very simple. Let me run through this with you. Alright, so remember, a put option actually is the right to sell. So at this point in time, the share price from 50 dropped to 20. Right, when it dropped to 20, the market actually can sell at $20. You have a put contract, you can allow you to actually sell. You have the right to sell at $50. Will you want to sell in the market at $20, or you would rather exercise to sell your shares at $50? Naturally, you want to sell high, so you want to sell at $50. Am I right? So when you exercise your share, you sell at $50, you have sold your shares. Alright, but because you pre-sold it, you don't even own the share, so you need to buy back the share in certain way. Alright, so you buy back from the market, immediately buy back from the market at $20, net profit you actually will make $30. So this premium will actually worth $30 at this point in time. Okay, just give you another example. Company XYZ, right? Share price at $80. Alright, you have a premium. You want to expire in 3 months' time. Alright, let's say the share price actually dropped, okay, to $40. What do you think is the value of the contract? Alright, let's speed up the process a bit. Let me run through 3 other scenarios with you. Okay, likewise, a similar question. You have a put contract, strike price at 80. 3 months later, assuming the price stays flat at 80, what do you think is the value of the contract? Right, third scenario, share price you have a put contract, strike price at $80. 3 months later, instead of going down, the share price went up to $100. How much do you think the contract is worth? Alright, you might want to pause the video to work it out a bit and just come back in a couple of minutes. Right, so how is it? Do you work it out? Alright, so let's run through this together. Okay, so in the first scenario, if you have a strike price of 80 and after 3 months when it near expiry, the share price dropped to 40, how much the value of the put contract? Alright, in this case, it's over $40 because if a share price, you have the right to actually sell at $80 when the market is 40 now, you want to most likely want to sell at $80 instead of selling at $40. Right, so if you have sold at $80 but you do not have a share to sell in the first place, you need to actually buy back from the market to cover up the difference. Right, so if you're just going to buy at 40 from the market but you have sold 80 initially, you were able to actually profit $40. So this contract will worth at least $40 at the end of expiry. Right, how about the second scenario where the share price stays the same? Right, if you can sell at 80 when the market is 80 now, likely there's no differences. You were just going to sell at the market at $80. So you will leave this contract worthless, just let it run by itself, and it just doesn't worth anything. You won't be doing anything at all. Right? And how about the third scenario? You have the right to sell at 80 when the market now is selling at $100. Would you want to sell at 100 or you want to sell at 80 by exercising your contract? Naturally, you want to sell at 100 because you can sell at a higher price rather than exercising. So since you're going to sell at 100, you're not going to exercise your put contract to sell at 80. This contract will actually become worthless as well. So things that will pretty run through quickly. If you're still unclear, you might actually want to pause this video and rewind back to where is individual section, either the call or the put option again, to watch it all over again, right, to understand this segment. Alright, okay, if not, we will just carry on. So we have actually just run through the call and put option. Of course, for every call and every put option, there are always a buyer and a seller. Just like any form of transaction, there must be a buyer, there must be a seller. Okay, so let's put the numbers in different perspective for the buyer and the seller to actually work this out together. Right, so do you still recall we have this example earlier, company ABC on this call option, you have the right to buy. Okay, so let's just run through. So let's say on the first scenario where the share price actually went up from 20 to 40, what is the difference when the buyer and seller come into the picture? Right, so if you are the buyer, right, at the start you will have paid $1 to buy this call contract. Alright, and when the share price actually went up to $40, you will have profited $20 because the premium actually worth $20 at that point of time. You have paid $20, but because you have paid $1 upfront, so your net P&L is actually in profit plus $19. Right? Okay, how about the seller? Alright, the seller, you have actually collected $1 because the buyer have paid you $1 upfront. Okay, but when the share price went up to $40, you will actually require to pay the buyer for $20, right? So net all, you have to pay out $20, but you collected $1 upfront 3 months ago, so net you have lost $19. Get it? So how about second scenario, if let's say the share price went down. So likewise, for the buyer, you have paid $1 to buy the contract initially, but when the share price actually went down to $5, alright, do you get back anything? No, you don't get anything because the contract is worthless now. So you have technically your P&L will be -1 because you have paid $1. Okay, how about the seller? The seller have already collected $1 at the front, alright, when they sold you this contract, and 3 months later when it expired, because the contract become worthless, the seller doesn't have to do anything, alright, so they don't gain or lost anything, but net P&L, the seller will actually profit $1. Alright, so as you can see from this chart, for a call option, a buyer will gain when the price move up, and it's kind of unlimited as how far the premium worth is going to be. But when it's lost, when the share price went down, when it's lost, while the buyer maximum will actually lost $1, or rather the amount that it paid for the premium when you buy this contract. Right? How about the seller? Okay, the seller, okay, at the front, if the share price went up, right, you stand a chance to lose a lot of money because you are selling away the contract. Okay, when every time if the price went up higher, right, the buyer actually profit, that's where your loss going to come in. Okay, but if let's say the share price went down, right, at the end of the day when the call contract actually expire worthless, no matter how low the profit, or rather how low the share price go, right, as a seller you will only maximum profit from the premium that you collected upfront. So in this case, the seller can only collect, or rather will just only profit $1 because he actually collected $1 premium when the buyer actually buy from him or her, alright, at the upfront. Right, I hope that's clear. Okay, and then let's move on to the put contract. Is pretty much similar. Remember, the put contract is the right to sell. So let's put this into picture. As an owner, as a buyer of a put contract, upfront you have to pay, let's say in this case, $3 to buy this contract. Alright. So when the share price actually dropped to $40, the contract will actually worth $40. So the buyer will actually make a profit of $40. Alright, so net in total at P&L, the buyer will actually profit $37 in total. How about the seller? The seller will actually collected $3 upfront because the buyer had paid the premium to the seller. Alright, but because at the end of the day, right, the share price went down, the seller actually had to pay back $40 to the buyer. Alright, so net in all, because the seller had to pay out $40, but he or she had collected $3 upfront, right, net, the seller actually will lost $37. Alright, okay, how about the next scenario? Let's say the share price went up instead of went down. Alright, so the buyer will have paid $3, same thing, going to pay $3 to buy the contract. Okay, but at the end of the 3 months, the share price went up, the put contract is not exercised, the contract actually worthless, the buyer doesn't actually gain anything of it. And then, so net P&L, the buyer will actually have lost $3. Okay, how about the seller? The seller upfront will have collected $3. Alright, at the end of the expiry, the share price went up, the contract become worthless, there's nothing to do with the seller, you don't make or lose any money, but at the end of the day, net when you calculate your P&L, the seller actually gained $3 in total. Alright, so that's how call option and put option it works when you actually put a buyer and seller into the picture. Alright, so this might get a bit confusing because you might be new to this, but it's okay because it takes a while. I myself takes a while trying to understand it, and while I learning through the process, I actually review this a couple of times until I get it. So it's perfectly fine. Don't get worried if you don't understand and this is your first time watching this video. Alright, just pause the video, rewind back, or go all the way to the start and re-watch it all over again to understand over and over and over again. Alright, okay, so just a quick summary. Okay, so actually why people actually do option investing, because they want to use option as a form of financial instrument to help them. Alright, okay, so option basically just like any contract, it has terms and conditions. Alright, mainly looking at the type of contract, which is put or call, the normal quality. One contract always referring to 100 shares, right? There's always a strike price, or what we call the agreed price on the contract itself that we take reference from. And every contract, there's always an expiry, right? Because no contract runs forever. For an option contract, there's always an expiry, and for every option, there's always a value to it, and basically what we call it a premium. Alright, so not to forget, I think we have run through this couple of times. So in the option world, basically there's two type of contract: the call contract and the put contract. And the call contract is actually the right to buy, and the put contract actually is the right to sell. Alright, okay, I hope this actually helped you to quickly and just in the most simpler form trying to understand what options are and how it works. Okay, once you understand and master this, then you actually go in the next few video to talk about some basic and simple to use option strategy that can help you if you are interested in investing in the stock market using the options. Alright, okay, so I hope you like this video. I hope this video are clear. Like I said earlier, if it's unclear, please rewind back, go back to the start or to the individual segment, actually watch over again to understand how calls and put option works. The most important thing, you need to derive what is the value of the contract at the end of the expiry. Alright, okay, thank you for watching. I hope they are useful. If it's not clear or anything you need me to clarify, please post on the comment below. I will try my best to explain it all over again. Alright, okay, just post a question below and I will get back to you. Okay, so thank you for watching. Look out for the next few videos because I'm going to talk about something more interesting, because we're going to go a little bit more in depth about the basic option strategy that you might be interested to know, to find out how you can actually utilize them, use them, right, to help you to make money in the stock market. Okay, with that, thank you very much, and I'll see you in the next video. Goodbye.